This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
In Chapter 18, we deal with the losses that may be sustained by a company. The losses are twofold. They are mainly the trading losses that are sustained, and that is the vast majority of the lectures, the two lectures that we have in this particular chapter. But also we have non-trading losses as well. So the big one is trading losses, where what we know is on a corporation tax computation, as with an income tax computation, if now the company sustains a trading loss, then the trading income assessment is nil. We never have negative bracketed figures going on to a tax computation. If a loss is sustained, the assessment is nil, and we separately deal with, okay, so what can you do with that loss? And when we looked in income tax at this situation, we saw that what you could basically do, there we were talking about tax years, here we'd be talking about accounting periods. But what you could basically do is look to use that loss in, for income tax, the same tax year, now in corporation tax for the same accounting period. And we may also then go in either of two directions. If we stay in this current period, stay where we are, we could possibly carry forward and set it off against future profits, or, and usually the better of the opportunities, the more likely to be tested on you, is that we may also be allowed to carry back the loss. If we can carry back the loss and set it against profits of an earlier accounting period, for which the tax on the profits made in that period have already been paid, and now we can reduce the profits of that earlier period with the loss relief that we've now sustained. The loss we sustained and the loss relief that is available for it. We can carry back, take out profits, reduce the liability, but we've already paid that tax by now, and we can get an immediate repayment of the earlier tax that we had paid. That would be a good use of the loss. We don't have an issue here about tax rates now, because the corporate tax rate that we've seen in place for several financial years has been 19%. So whether you use a loss this period, last period, next period, we're talking about using the loss and gaining the relief, therefore at a 19% tax rate. So the main issue there, therefore, would be, at least to begin with, about cash flow, gaining relief at the earliest available opportunity. Another cash flow issue that you'll see explained in the two lectures that we have, as I say, coming up here, lectures, by the way, that will be taken from Finance Act 20, the old lectures there, because there have been no changes in the rules whatsoever. But in terms of those lectures, looking at the reliefs that are available, current period, carry back to an earlier period, or periods carry forward to future periods, we have to know where we can relieve, against what can we relieve, the same questions that we had to answer effectively when an unincorporated trader sustained a loss. And we'll also look to say, well, if we've got choices, which you have, then what objectives are you trying to achieve? And we've said there, given that the tax rate doesn't change, we're reducing profits for any of those periods that would be taxed at 19%. It's all about, well, one, gaining relief at the earliest available opportunity. It's a cash flow issue. And coming into that is also the idea that if profits for a certain period are quite high, such that the company would be a large company, then we have spoken of in our first chapter 16 lecture, and you'll see the details of it in chapter 23. But if the company were to be large, then the quarterly instalment payment system may become operable. Now, you do not want to be paying tax sooner than you need. We would far rather just have the normal due date of 9 months and 1 day after the end of the accounting period to pay all of our tax liability, than have the quarterly instalment payment system, which means that we would actually start paying this period's tax just over halfway through this current accounting period. Now again, we would rather not have to make those upfront instalment payments. We would far rather pay everything as late as we possibly could. So we'll talk about the objectives that we're striving to achieve, and show how those reliefs operate. Now, I say all of those rules, all of the reliefs that are available are the same as they have been in previous years. Hence, we'll be using the lectures that we use for Finance Act 2020, i.e. last year's lectures there. We've had no changes in the rules, as we've said. Just a couple of points to note for you, that in the first of our lectures that's coming up in just a few moments' time now, on screen you'll see that the old study notes, in the very first section 1.1, there's a third paragraph in those old notes that is no longer in the current notes. And the reason being that it refers to pre-April 17 losses that are not examinable within the Tax UK paper. So that paragraph has now been removed. Now, it only takes me about 30 seconds to just talk you through that, basically one sentence, paragraph 3 there. But again, it's not changing anything. It wasn't examinable. It isn't examinable. We've now moved on a long time from 2017, so I've just simply removed the note. We don't need to worry about it. Also, in the lectures, the example dates you will discover, they are, of course, 1 year earlier than the Finance Act 2021 study notes that you have in front of you for those examples. In the lectures, they're just a year earlier. But again, apart from the dates of the accounting periods, there's no changes in the application of those rules. So, next two lectures, the old lectures, as I say, ensuring that we know how to deal both with trading losses and also only a small amount of work on the other one, non-trading losses. All of those will be dealt with. Well, what we've seen in the previous two chapters is the basis for preparing the corporate tax computation that we work from, given in a question the statement of profit or loss. That, of course, is the period of account. We produce the corporate tax computation for the accounting period. They are usually the same, but the accounting period cannot, of course, exceed 12 months. If we have the long period account, as we saw in the previous chapter 17, then we simply break it into two corporate tax comps, two accounting periods, the first of 12 months and the second the balance of the months of that period of account. Now, a Section C question, that 15-mark guaranteed corporate tax question, will frequently, no doubt, be the preparation of a corporate tax computation the way that we've seen it. The examination for 15 marks worth of question, of course, is going to have, as we said before, a lot more adjustment of profit issues, capital allowance issues, capital gains issues, the more detailed content in terms of the items listed on that corporate tax computation. But if you're going to get anything other than that, then probably now in Chapter 18, it's a losses question that we may see. Equally, individual points about these losses lend themselves, of course, to Section A objective testing questions, just as do all of the issues about the preparation of the corporate tax computation itself. Now, we've already been introduced in the Chapter 16, I think it was, to the, as we said, the content of the computation. And when looking at two of the items, property income and capital gains, we put forward, of course, the idea that we don't always have positives as those outcomes, that we on our property income, we may have more allowable expenses incurred than we have rental income accrued. On that basis, there is a loss. We know that wherever there are losses, then we will have a nil assessment, not a negative figure going to the corporate tax computation. And we saw then how to deal with that loss. Don't worry, a reminder of that is coming up in a short while. But that we've dealt with property business losses, the way in which we must use them in the current period against total profits, and then we carry forward. In terms of capital gains, we may, of course, not always make capital gains on dischargeable disposals that have been made. And therefore, if we net a capital loss for the accounting period, we can't offset that against any sources of income. We can only carry forward against future net gains in future accounting periods. Again, we know those two. We have a further note on them just a little while after this first note, But here is the main issue to do with losses, and it is of course dealing with trading losses. Once again, just because you trade, it doesn't guarantee that you're going to make a trading profit. So we may sustain a trading loss. And we do see some similarities here in terms of what we do on a corporate tax comp and computations compared to what we did in income tax computations. We've already said there that if we make a loss, the assessment is nil. And that's the first basic point. Again, a series of essential key points are firstly listed in this chapter. So if the company makes a trading loss, its trading income assessment for the period to include in the corporation tax computation is nil. We're never putting a bracketed figure in, it's a nil assessment. And instead, we then set up a loss memorandum to show how and where we will use that loss. Now, we know that we prepare corporate tax computations for accounting periods. What we saw in income taxes, we prepared income tax computations for a tax year. And when an unincorporated trader made a loss, there were basically three things that you could do. You could, if the unincorporated trader made his income tax loss, set off in the current tax year, carry back to an earlier tax year, or thereafter carry forward to a future tax year. So the idea is simple. In terms of losses when they're experienced for a period, in income tax, the tax year, now in terms of corporation tax, the accounting period. There are basically three ways you can go to use that loss. You can use it in the current period, as you could for income tax in the current tax year, by setting off against other amounts that would be chargeable to corporation tax in that current period. We'll discuss that in a moment. And other than staying where you are in the current period, there are two directions you can travel in. We can, of course, carry back to an earlier period, or we can carry forward to a future period. Now, what we have to learn are the order in which we would have to make certain of these relief claims. And when we relieve in current, carry back, or carry forward mode, what do we relieve against? What are the specific rules for the application of these losses in those specific accounting periods, whether it be current, carry back, or carry forward? And of course, when you do carry back, how far back can we carry that loss? Right, let's get the detail of that now as contained within these notes. As we've just said, that loss may then be relieved in the current period. Now, against what in the current period? Good news to a degree here, it is against total profits. So all the other sources of income and capital gains. We don't have a problem putting a trading loss against capital gains. As we just said, you can't put a capital loss against sources of income, but your trading losses here, no problem. They go against total profits. If and only if we make that claim, may then be followed by a 12-month carry back to, as we say here, an earlier period or periods. Now, normally it would be an earlier period. We would usually expect a company to be regularly preparing its accounts to a specific year end. Therefore, when in an accounting year you experience the trading loss, if you have, as we'll discuss in more detail in a moment, if you've made a current period claim against total profits, that will then allow you access to a carry-back claim. Now there it would be to the previous accounting year end. It's specifically a 12-month carry-back. So if it's year end back to year end, it's just back to the previous accounting period. But as we've said, accounting periods could be less than 12 months. Maybe you change the accounting date in the previous period, and maybe the previous period is 9 months long or 6 months long, in which case you are able to carry back to earlier periods. Again, you go back on a reverse chronological basis. So if this loss-making period was preceded by a 9-month accounting period, if the loss was big enough to eliminate all of the total profits of that previous 9-month period, it would then go against a further 3 months of the accounting period prior to that. It is a 12-month carryback. Normally that 12-month equates to the preceding accounting period, but don't learn it that way. It's a 12-month carryback. So if that preceding period should be less than 12 months, you take out all of that period to the extent that there are losses available to set off against its total profits, and then go back the balance of the 12 months. So if it was a 9-month period, back then a further 3 months from the period prior to that. It's a 12-month carryback. Again, as in the current period, against total profits. Now, you don't have to make the current period followed by the carryback claim. You don't have to make the carryback claim, if you don't want to, after the current period claim. But anything that is not used in either current and thereafter carryback claims, there's only one direction. There's only one direction in which the loss can then go, and that's a carry forward. And when we go forward, the carry forward to relieve against, notice here it is again total profits, but this time a very important statement made: any part of those future total profits. So what that is showing us, and no need to separately note it, it is noted here in a moment's time, is that whereas with a current and carry back claim, you go against total profits to the extent that there is loss to set off against those total profits, there are no partial claims available in the current period or the carryback claims. When you carry forward, partial claims are allowed. You can use any part of that carried forward loss against any part of those future total profits. It begs a question about, well, why would you choose to use less loss than you are able to use? That's when you've got to recall the structure of that corporate tax computation and know what total profits is. Total profits is not taxable total profits necessarily. There may be qualifying charitable donations. So importantly here, those set-offs go against total profit, which is before the deduction of qualifying charitable donations. And if those donations exceed the total profits, or indeed if there are no total profits to put those donations paid against, then those qualifying charitable donations are wasted. If they are not used in the accounting period in which they are paid, they are lost. You cannot use those donations paid to reduce profits of any other period other than the period in which they were actually paid. So there's a problem with your current and carryback claims. You can't make partial claims, you have to go against total profits to the extent that there are profits. But when you carry forward, you are able to limit the amount of loss you set against the total profits to avoid any possibility of wasting any donations that may have been paid in that future period. Let's just put some more detail therefore in on that and explain those points I just discussed with you and look at the notes here before you. The use of the loss carried forward in this way is only available for losses arising from the 1st of April 17. You're not going to worry about learning that date because thankfully brought forward losses that arose prior to April 17 are excluded from the syllabus. So the only losses that we will see will inevitably be those that have arisen since the 1st of April 17. Note, as we've said, that if a company wishes to carry back a loss, then it must firstly use the loss in the current period, and unlike with the carry forward claim, partial claims are not allowed in either the current period or the carry back claims. So again, absolutely vital to understand. Current and carry back against total profits in full, no partial claim. If those losses take out those total profits, then there is nothing left for the donations, if there were qualifying charitable donations paid. If they were paid, there's nothing to deduct them from, and therefore the use of them is lost. They are wasted. When we carry forward, either because we've chosen to do that in preference to the current or carryback claims there, but when they're carried forward, again they go against total profits. That's where you show them after total profits on your answer page here. But you can choose to limit that claim so as to avoid wasting the qualifying charitable donations. Now that's summed up in terms of these factors that we need to consider when we are asked to advise and therefore choose the loss reliefs, choosing which loss reliefs to claim. So what are we trying to achieve to get the best use out of them? Clearly, a cash flow benefit of achieving relief at the earliest available opportunity. So a current period followed by a carryback claim is going to allow relief at the earliest available opportunity. Remember, carryback is the best you can get, but you can't carry back unless you've relieved against any other total profits in the current period. The relief in the current period means that you won't then have to pay the tax. Let's assume it's not a large company here, given that it's loss-making. You won't have to pay any tax there on those total profits the 9 months and 1 day after the end of the accounting period. That payment is avoided. But in so doing, it opens the door to a carryback claim. Now, by now, we are clearly after the end of the current period, I called it, the loss-making period. But we will certainly by now have paid all of the corporation tax for the period prior to it. So when we carry back to the previous period, we reduce profits. The reduction in the profits reduces or indeed potentially eliminates all of that previous period profit and therefore tax charge. But we've already paid that tax charge, so we'll claim a repayment. We'll get our money back. Now, in terms of cash flow, it doesn't get any better than an immediate repayment of tax we'd paid for the earlier period there. Clearly worst in terms of cash flow is the carry forward. The earliest you could use it is in the next accounting period following the loss-making period. The tax for that period would be due again, let us assume, 9 months and 1 day after the end of that period. So it's quite a ways into the future that you have to wait till you get any tangible benefit out of the unfortunate trading loss that you have just sustained. But it might still be an idea to have that carry forward, because as we will see, the cash flow benefit, of course, is a major issue, and that is current period and carry back claim as a preference to the carry forward claim. The problem is that the current and carry back claims may waste qualifying charitable donations. So clearly an objective is to avoid wasting the qualifying charitable donations. A further objective, we'll talk more about how we can get the benefit of avoiding wasting qualifying charitable donations. We'll talk about that again in a minute. But the other objective to get the best use out of these losses that you should be aware of is reducing profits below the relevant profit limit to avoid having to make quarterly instalment payments. Yeah, quarterly instalment payments. If you're estimating you're a large company for the current period and you were a large company in the previous period, then those quarterly instalment payments bring forward hugely the point in time at which you have to pay your tax. Remember, as we've just said, if you're not large, you don't pay the tax for a period until 9 months and 1 day after the end of that period. But if you are a large company and you're estimating large for this period, you've got to start paying those quarterly instalment payments starting on the 14th day of the 7th month from the start of that accounting period. Assuming it's a year end, that's just over halfway through the accounting period. you start to pay the corporate tax for that period, rather than as it would be 9 months and 1 day after the end of that accounting period. So that, in cash flow terms, again, is very bad. So we've got the objectives. We want to get the greatest cash flow benefit out of the use of our losses, and that means using them sooner rather than later. It also means, if we can possibly do so, bringing profits down below the profit limit. Remember, for a single company with a 12-month accounting period, the profit limit was 1.5 million. That, of course, was reduced in situations of a short accounting period or where there was a group of companies, related 51% group companies, as we call them, where they existed. So we want to get the best cash flow advantage in terms of the use of the losses, but also, if we have been making, and not all companies do make, though in exam questions they do, qualifying charitable donations, we don't want to be wasting those donations through using a loss relief that then eliminates the total profits and there's nothing left to deduct the donations from. Okay, so current period and carryback claims cannot be partial, as we know, as we've stated above, and hence run the risk of wasting the relief for the qualifying charitable donations, as total profits, as you know, are before the deduction of those donations. And if they are unused for this period, then they are wasted. There's no carry back or carry forward of those unused donations. If, of course, the loss is carried forward, then a partial claim would be available, and that would allow us to avoid wasting any qualifying charitable donations. If we've got next year total profits of £100,000 and we have got donations paid of £10,000, then if our loss was, say, 200,000, normally 200,000 against total profit of 100, if it were a current or carry back claim, 200,000 loss is bigger than £100,000 profit, so the whole 100,000 would go, and that would waste the donations. On a carry forward claim, with our loss, we only have to use 90,000 of our 200,000 against the £100,000 worth of profit. On that basis, therefore, that still leaves £10,000. So we can make partial claims to reduce the total profit down to a figure equal to the qualifying charitable donations, because any loss not used on that carry forward claim can be carried forward again. There is no time limit as regards the carry forward. We can continue to carry forward so long as the business continues to trade. Okay. A current period claim, as we've said, followed by a carryback claim, will, however, have the cash flow advantage over the carry forward claim, thus using the loss at the earliest available opportunity there. Further, most important cash flow issue again was to avoid, if we could, the requirement to pay our corporation tax liability by quarterly instalments. And again, the details of how that quarterly instalment system works, if you haven't already looked at it, is in chapter 23. You will find it there. Although at this point and in this chapter and in the previous two chapters, we have been dealing with the preparation of a corporation tax computation or computations for a single company, in chapter 22, as we've mentioned on a number of occasions in our discussions so far, we deal with groups of companies. And what we are told here is that how we use these losses and getting the best use out of them. This may be particularly important within a group of companies where group relief of losses, as we've said, we don't do it now. We've got an entire chapter dealing with groups, chapter 22. Where group relief is available and allows any part, here we go, like with a carry forward claim, we have flexibility as regards the use of the loss. Any part of a trading loss made by one relevant group company when I use the word there, relevant group company, that relevance is based on the percentage shareholding that a parent company has within a subsidiary company. It has to be sufficiently high. You'll discover in Chapter 22 that the sufficient height is 75% in order to allow group relief. So you've got to have at least that 75% control to be able to use a loss in this way. And we can use any part of the loss-making company, the trading loss, and set off against any part of the TTP, so not now total profit, but taxable total profit of any other relevant group companies. So what that would mean, if I just advance our studies of groups for one moment, if we've got a holding company and we've got S1 and we've got S2, both of these are wholly owned subsidiaries there, we might have the holding company with a TTP of 600,000, S1 with a TTP of £550,000. Again, just this is bottom line taxable total profit. And S2, we are talking about a trading loss of £250,000 there. Now, S2 may have other amounts chargeable. It could have other income, it could have capital gains. But what group relief does, and you will see in Chapter 22, is to allow, as we've just said, any part of a trading loss. So any part of that trading loss of 250, all of it, some of it, none of it, up to you, may be used in terms of group relief. Now, the point that I'm making to you here is again about avoiding quarterly instalment payments. Now, what we need to know, of course, is the relevant profit limit for each company within the group. Remember, we had related 51% group companies. If you can't remember that, you go back to where we saw that. I think it was in Chapter 16 there. Now there, you've got the parent company and two wholly owned subsidiaries. All three companies are related. So the profit limit for each, there will all be 12-month accounting periods here, divide by the number of related 51% group companies, and we've got £500,000. Now, of course, that's why I chose the figures of profit that I have, because the holding company has a profit of 600, that exceeds 500, and therefore is large. The subsidiary 1 has 550,000, again in excess of 500, it is large. And on that basis, therefore, what we would now be able to do is not just use S2's trading loss of 250, as we've been introduced to in this chapter, in terms of a current period claim, a carryback claim, a carry forward claim just within S2. Now, because of the group structure that exists, it would allow group relief to apply. And that means that that 250,000 loss could be shared out in any way we choose amongst the other group members. Now then, I know we haven't studied groups yet, and this is new to you. I've only just introduced the concept of the use of these losses. But you have a look at what we have there. We have a profit limit of £500,000. We have profits here for the holding company and for S1 in excess of 500,000. We need to check, of course, that each of those two companies was large in the previous accounting period. And on that basis, therefore, it would mean that quarterly instalment payments would be due for this period. The use of the loss would, of course, allow us, if we'd already would have done some of those quarterly instalment payments, to get our money back. We could avoid those quarterly instalment payments. And even if we weren't large in the previous period, and therefore there were no quarterly instalment payments for this period, if by the use of this loss we can reduce that 600 down to at least 500, that 550 down to at least 500, then if you're not large this period, then it doesn't matter if you're large next period, you're not going to have to make quarterly instalment payments. So how much of your loss as a minimum would you want to group relieve against the £600,000 taxable total profit of the holding company? Well, you need to bring down the profit to the profit limit of 500,000, assuming that the only dividends received by any of these companies are the dividends received by the holding company from subsidiary companies. The dividend income is excluded in computing the profit figure to go against that profit limit. And on that basis, you'd simply use 100,000. You can go more, of course, there, and 50,000 there. You could guarantee you use 150 in that way. 100,000 against H to bring it down to 500, 50,000 against S1 to bring it down to 500. The other, again, 100,000, you could group relieve that. You could take out more of the profits of holding company or S1. You could use it within S2. That's down to you to decide. But there you see, from a planning perspective, there's a lot more interest involved here, because you're not just using the loss in terms of a current and carryback claim where there's no choice other than, do I make the claim? It goes against all of the total profit. With group relief, you get to choose how much of that loss to put against that total profit. Now that is a skill, it's a planning skill, and therefore is rewarded in your exam with bigger marks. Again, remember, marks are not just a function of how much time it takes you to perform a particular act to earn that mark. They're also a function of the skill level involved. And using group relief in this optimal way, well, that is a skill area, and therefore would come with a premium of marks allocated to it. Now, I hope you've understood that there, and I know I digress from time to time. We'll be dealing with it again, don't worry, in chapter 22. But when you're dealing with a single company, the only issues we're looking at: current period claim, carry back claim, carry forward claim. If the company in question is part of a 75% group, then a further use is possible: group relief. And because of the flexibility of group relief in that current period, you are able to use as much of that loss as you choose, and that gives you that flexibility to get the best use out of it. And the best illustration of where that would be of greatest use is in bringing down profits of those companies within that group to the profit limit, to avoid quarterly instalment payments being made, if not just for this period, then for next period for sure. Okay. Moving on from the trading losses, and we'll focus our attention on examples on that in a moment's time. Non-trading losses, we mentioned those at our point of our introduction: property business losses and capital losses, and those we have already dealt with in terms of our first introduction to the corporate tax computation in chapter 16. Remember how you get a property business loss: more allowable expenses incurred than a property income accrued. They must then be set off against total profits, which again, as you know, is before the deduction of those qualifying charitable donations of the current period. Now, it is very unlikely that those property income losses would be bigger than the total profits of the company. But if they were, then just one use: carry them forward to set off against any part. Again, flexibility on the carry forward, as we have with trading losses, as we've just learnt there. On the carry forward, any part of future total profits. Or indeed, as we've just discussed, even those excess losses after must always be the current period claim first of all. That's always priority. But then, if you don't want to carry them forward, if you have the ability to group relieve them, then you can do that instead. Capital losses, you have to net off any capital losses made in the accounting period against any chargeable gains of that accounting period. If it is a net overall capital loss, then those net losses would be carried forward to set off against then net gains in future accounting periods. So if you have a net capital loss for the current period, that is after offsetting the losses against the gains, can't go against any income in any of these periods, you carry forward against the future net gains. Okay. But we've been discussing, and now we'll continue with for the rest of this chapter, the use of those trading losses. And we'll look at a couple of basic examples on the use of these losses in the current period and in carry-back mode to finish off this particular lecture and save the rest of it until the second lecture. Current period relief. The loss may be relieved against the total profits, again before deduction of the qualifying charitable donations, in the period that the loss arose, the current period. The loss must be applied in full if claimed. No partial claims are permitted. So there we go, example 1. What do we have? We've got A Limited, year ended March 21, and we have a trading loss of £45,000. Now on a corporate tax computation, that of course would read as a nil assessment. But there are other amounts chargeable. We've got interest receivable and we've got a one-off chargeable gain. That would form therefore total profits of £70,000. Total profits 70,000. Before then being able to make a deduction against those total profits of 15,000 in the form of qualifying charitable donations. But what are we going to do with that £45,000? If you want to use it at the earliest available opportunity, that means, and always means, in order, firstly current period claim, and then if loss remains, carry back claim. So where a question says in its requirement to you to assume that relief is claimed at the earliest available opportunity, and that's a frequent requirement, then that means current period claim to the extent that there are total profits, and then any balance of unused loss carry back 12 months, normally equates to the preceding accounting period, but then it's the 12-month carryback. Now here we've got a loss of £45,000. That's where it would go. The 45,000 against total profits, not TTP, total profits. That would bring you down to, what's that, £25,000. That would be your revised total profit. And then from that revised total profit, you've got your donations to deduct of 15,000. And that would still leave you with the TTP of £10,000. The loss relief in the current period would use up all of that £45,000 of loss. It would equally not involve any wastage of your qualifying charitable donations paid, because the amount of loss used still leaves their total profits sufficient to cover the donations paid. But understand that if that loss, instead of their 45,000, if that loss had been £100,000, then the only claim, if you make the current period claim, the only claim that could be made against that £70,000 there would be £70,000. You'd have to use 70 of that 100,000. That would therefore bring down your total profits to nil, which means your £15,000 worth of qualifying charitable donations would have nothing to go against. That means they would be wasted, they would be lost. Therefore, a reason there may be to choose instead to carry forward that loss, because on a carry forward against total profits, then you can use any part of that loss. Mind you, begs a question, why when we're making these losses are we making such donations to charity? I think we should be registering as a charity, not actually giving and making donations to them there. But again, these are the things that examiners put together for you. And again, something like this could be very easily a 2-mark objective testing question outside of the context of a bigger Section C question. So that's current period. With the loss as it was of 45,000, it was all used in the current period and there was no wastage of the donations paid. If we had £100,000 of loss, then the current period claim would have to be against the full total profits of 70. That would leave 30,000 left over. That 30,000 would be available for carry back. But in so making that current period claim, we would have wasted the deduction of those donations. Let's remind ourselves about the carry back relief. Having first relieved the trading loss in the accounting period of loss, we keep calling it the current period there, only then may any remaining trading losses be carried back, again against total profits, which again, as ever, I keep putting it on, but it's before the deduction of qualifying charitable donations, and the carry back is of the preceding 12 months. Again, usually that is just to the previous accounting year end, but it's very specifically a 12-month carry back, as we'll see more about that in our next lecture in this chapter. The loss must be applied fully against the available profits. There are no partial claims allowed. Partial claims, for example, to leave sufficient profit to cover the qualifying charitable donations, are not allowed here. These claims may therefore result in no tax relief being achieved for those donations, the point that we made a moment ago. Now, just one final example to finish off this particular session here. We'll return to losses in our next lecture, as we said. Now, we've got a situation here with A Limited where, there you go, there is your loss-making period. Each of these accounting periods are year-ended the 31st of March. So here, the possibilities of claim are, in the current period, what other profits do we have? Remember, the 90,000 loss will be a nil assessment. We have £10,000. If and only if we make that current period claim, may we then go back. How far back can we go? 12 months. All of these accounting periods are year ends. So that's it. We can only go back to the year ended the 31st of March 2020. We cannot go back further than 12 months. So these profits here, we cannot touch. Those will not be relievable. So all we've got therefore is current period, a £10,000 claim. The carry back, that would be 70,000 there. Well, we'll look at the model answer to this in a moment, but you would keep a little loss memorandum working going where you'd have started with 90, you'd have then had your current period claim of 10, that would bring you down to 80, then you'd have your carry back claim, that's 70,000, that would still leave you with 10. There's only one thing that can be done with that, it must be carried forward. Now, again, you have a look at what we've done there. I know I've gone through that quickly, but hopefully you've got the idea behind this. To relieve as soon as possible equals current period claim followed by carry back claim. Both are against total profits, both there are no partial claims. There's your current period total profits, 10,000, because the loss gives, as ever, a nil assessment. 10 from 90, as shown here, would lead you to £80,000 remaining. The carry back, 70,000 in the previous accounting year end. All of that will go with a carry back claim, leaving £10,000 to carry forward against any part of the future total profits of a subsequent accounting period. Any part of those future total profits. Okay, let me just show you how that is presented here. When dealing with, as it would be a section C question, where there are, again, there's always the period of loss. They're always going to give you a previous period or periods to allow you to demonstrate the 12-month carry back. And they're also probably going to give you the next period so you can demonstrate the carry forward in terms of the use of those losses. As we know, the year ended March 19, we can't touch anyway here. So the two critical periods are your current period and then your carry back. Again, nil assessment for the loss. Pick up the figures from the question, copy them in from the question to your answer to get firstly total profits there for each of the current period, 10. That is the first claim, £10,000. That is recorded in your loss memorandum. Loss memorandum here, where the loss arising for the year ended March 21 was 90,000. How do we relieve it? Current year, current period relief, that's the year ended March 21. There's your first use, 10,000. That leaves 80,000, the 70,000 total profits. There is your second use, 70,000, leaving you with, therefore, that equals 10,000 to carry forward. And again, on a written question, you would show this loss memorandum working, as well as this working here, where you've got this columnar working for each relevant accounting period, showing where on those workings the loss has been applied against total profits. And also then the loss memorandum. Those are the two things that you need to present in terms of a section C answer to such a question. You need your columnar analysis for the accounting periods, identifying, as we've said, the total profits, and if relevant, any qualifying charitable donations, and leaving space for where the loss reliefs are applied. Here, the current year relief use first, against, of course, total profits, and then followed by the carry back relief. If you do have anything to carry forward, then if they didn't give you any total profits for the next period, it would then just be a written response saying what could be done, what will be done with that 10,000. And that would be available to carry forward against any part of the future total profits of that company. Okay, plenty for you to be revising through, therefore, before next time. But next time, we'll pick it up and continue from this point, deal with just a few other issues pertaining to the current and carry back claim, and then looking at one specific scenario that has to be dealt with, which is the cessation of trading and what happens when you cease trading. Because if you cease trading, there's no possibility now of carrying forward that loss. So if you can't carry it forward, what other possible use could you have of it? Well, we know the normal rules allow current period and then a 12-month carry back. So the only way in a terminal loss situation we could do better than that, because there is no carry forward, you've ceased trading, is of course to be allowed to carry it back further. Just as we did with the unincorporated trader on cessation of trading. If you can't carry forward, which you can't, you've ceased trading, then you're allowed an extended carry back. And that's the other and only other specialist situation that we need to be looking at to begin with in terms of these losses. After that, there's just one further relief that we'll need to look at, but that awaits us in a future lecture.